So what are true deltas versus phantom deltas? Sometimes you'll hear these called hard deltas versus soft deltas. This is something that a lot of traders stumble onto by accident after years of trading, and they're left scratching their head going, why in the world did this happen? Well, there's no reason to have to learn this stuff by accident when you can figure out what phantom deltas are and why they occur. So before we get started, as always, please be sure to click like and subscribe. Definitely very much appreciated and helps to promote the channel. So let's start off with delta. Recall that delta is one of our Greeks. It's an output from a pricing model, and it simply shows the sensitivity of your options price in relation to the stock's price. So let's say we have the $100 call that's trading for $5, and your broker's platform says that it has a delta of 0.70. What you can think of is that this option, at least right now, is picking up 70% of the changes in the value of the stock. So if the stock rises $1 right now, that call isn't going to pick up a full buck. It's going to pick up 70% of that dollar, or 70 cents. So we would expect that call to be trading for about $5.70. So the thing that makes delta tricky is that it changes as the stock price changes, and it changes over time. So for example, let's say that this is our $100 call at expiration in red. The current curve might look like this. And so our delta is always measured between two small points on this blue line. So let's say the stock is down here around 80. If we put a couple of dots, laid a ruler across there and looked at the angle of that red line, that's the delta. Now, of course, out here on this red line at expiration, we know that's delta 1. So you can see that this is very flat. This is far away from delta 1. It might only be delta 20. But you can also see that as the stock price starts moving out this way, we start climbing up this blue line. And so that slope changes. Let's say that the stock is up near 100. We put a couple of dots there. We connect them with a ruler. You can see that the angle of this red line has now gotten a little steeper. And we might find that it has a delta of 50. And then finally, if we get the stock way up here, deep in the money option, we might see that the delta is running pretty parallel to this red line. We're getting close to 1. We might be delta 95 at this point. But the idea to see is that you are close to delta 0 way out here to the left, and close to delta 1 way out here to the right. So once you understand that, let's compare two different calls. And I'm going to make this a fairly extreme example just to make the point clear. We're going to compare an in-the-money option. Let's say the stock is at 105. We have a 30-day $100 call. So this call is 5 points in the money. We're going to give it a volatility of 35%, and pricing model shows that it has a delta of 70. We're going to compare that to an out-of-the-money call. We're going to put the stock at 99. We're still going to use a 100 strike, but we're going to make this 2 years out. 720 days until expiration. We're going to pump up the volatility to 80%, and look what the model tells us. This also has a delta of 70. So we've made a lot of changes. The only thing we've kept constant is the 100 strike right there in red. But notice that I can still get both options to have the same deltas, even though one is in the money and one is out of the money. So here are some screenshots of the pricing model. There's the option price just over $7. There's the 70 delta. But again, notice the stock is at 105 with the strike at 100. It's 5 points in the money. So $5 of this $7 is coming from intrinsic value. Now let's compare it to the second option, stock at 99, strike at 100. And now the call is worth almost $42. But there it is. It's got a delta of 70 as well. So what's going on here? Well, what's happening is that even though that this is an out-of-the-money option, when you pump up the time to expiration and or volatility, it is adding deltas. These aren't really true deltas in the sense of that they're being driven by intrinsic value. Because if it's from intrinsic value, we know that at expiration that must remain. See, these aren't going to remain. So this is the idea behind a phantom delta. So you have to be careful, especially if you're using options to hedge and you're trying to maintain a 70 delta. This is not going to do it. Might do it for a short time, but not towards expiration. And in cases like that, you might want to lean towards short-term options that are deeper in the money. So here's what it can look like over time. Let's put our $100 strike. Remember, that's the same strike for both of these hypothetical options. And here is the stock at 99, and here is the other one with the stock at 105. So right now, both of them have a delta of 70. So it's as if they're both sitting on this same point on this curve. But that's only temporary, and that's the whole point. So as time passes, this line, the current curve in blue, is going to shift down to the red. And the difference between the blue and the red is your theta, your time decay. As more time passes, we shift down lower and lower and lower, and look what's happening. The second option, where we put the stock at 99, look at the level of these curves. They're starting to flatten. These deltas are moving towards zero. We can see that because they're moving towards this portion of the black curve. That's zero deltas right there. But look at these over here. They're heading towards delta 1. So as more time goes by, last few days, we start inching closer and closer to this black curve until right at expiration we land on the black curve. But once again, notice what's happening. Let's clear out all of these current curves. You can see that that second option, that was the longer dated one with the stock at 99, is moving towards zero. And the $100 call with the stock at 105, the 30-day option, was moving towards delta 1. And so even though they both started with 70 deltas, this one over here, the shorter term in the money one, really had what we might call true deltas, because they are not going to leave. That intrinsic value must stay, assuming the stock price doesn't move. But take a look at what happened over here. They started at 70 deltas, but they moved to zero. So that 70 delta that we saw on the original option was really what we might call a phantom delta. It's coming from volatility and time to expiration. So it's an important point to be aware of, whether you're just purchasing options and you want to use a long-term stock replacement, you want some true deltas in there, or if you're trying to hedge a position and you want to be sure that you maintain some level of deltas, you have to understand the difference between the true versus the phantom deltas. So as a recap, traders must understand that all deltas aren't created equally. Just because you see two options that have a delta of 70, as we saw in this example, doesn't mean that they are going to behave the same over time. True deltas have intrinsic value and very little vega. And so in other words, they're usually going to be shorter dated or be on an option that has a fairly low volatility. Phantom deltas, on the other hand, have little to no intrinsic value, but lots of vega. And that vega is coming from, again, volatility and or time to expiration. So the point to get from all of this is that before you start doing some of the fancier things with options, or even some of the simpler things for that matter, you must understand where your deltas are coming from and how they'll behave over time. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.